Assalamualaikum warahmatullahi wabarakatuh. I am ALYAA binti AZIZ, and now I will begin our presentation by connecting today's financial headlines to the core theories that we have studied. Our starting point is the Reuters report. Trump shook up global trade this year. Some uncertainty may persist in 2026. This isn't just a political news, but it is a real-time case study in international finance. My part will show you how this tariff shock initiate a dangerous chain reaction that directly threatens the two pillars of our global system, which are economic growth and also financial stability. Alright, my first point is that the prolonged tariff dispute reduce the global trade volume, which slows the economic growth. Our course note already mentioned that the global trade and finance are fundamental to economic growth, as they enable efficient resource allocation and productivity gain. The news article, which provide the shocking data, the average US tariff rate jumped from 3% to nearly 17% in 2025. This dramatic increase acts like sand in the gears of global economic engine. While the article notes some short-term resilience, like the euro absorbing a modest direct impact, the persistent uncertainty highlighted for 2026 create a prolonged drag. This environment chills long-term investment and disrupt efficient supply chains, directly undermining the growth mechanism. Therefore, the tariff shock is not just a policy change, but it is an active brake on global GDP expansion. This dangerous chain reaction will bring me to my final point, which is the potential need for intervention by international financial institutions like the IMF and also the World Bank. As we already learned, the IMF role precisely as it acts as a lender of last resort to countries experiencing balance of payment crisis. The sudden stop and resulting crisis we just discussed is exactly that, a balance of payment emergency with multiple potential triggers in 2026, including the Supreme Court ruling and also expiring trade deals. The risk of such crisis materializing is very significant. Therefore, the institution we study may transition from observers to essential crisis managers. Their role would be to provide emergency financing and stabilization program to contain the fallout, preventing a series of national default from escalating into a full-blown global financial meltdown.
Hi, Assalamualaikum warahmatullahi wabarakatuh. So my name is WAHEEDAH binti Muhammad ZAILAN, metric number 2315070. So next, I will be talking about how tariff caused exchange rate volatility. So based on a recent Reuters report about Donald Trump's trade policies in 2025, tariff will reduce flows and create uncertainty. So according to the article, US tariff jumped from 3% up until 17% this year and currently generating almost $30 billion a month of revenue for the US Treasury. As we know, when a tariff is applied, the price of imported goods become expensive. When prices goes up, demand falls. The flow of goods across borders decreases. Less demand for a currency means its value will start to shake or drop. This sudden tariff jump shook up the global market. Because business don't know what the taxes will be tomorrow, exchange rates are fluctuating widely and leverage market lead to volatile money values. Other than that, countries affected by this tariff often see their currency lose value or depreciate. According to the article, China still can reach a record $1 trillion trade surplus despite this high tariff. But how did they do this? The secret lies in currency depreciation. When the US adds a 17% tariff, China's currency often weakens. So this isn't just a coincidence, it's a strategic buffer. So when the yuan becomes cheaper, the cost of making a car or a battery in China also becomes cheaper when converted into US dollars. This price drop cancels out the extra cost of the tariff. For example, if a US tariff makes a Chinese EV $5,000 more expensive, but the yuan drop in value, that same EV might now cost $5,000 less to produce. To the American consumer, the price stays the same. The tariff becomes invisible because the currency movement absorbs the shock. Furthermore, the article notes that China is not just relying on the US anymore. They have flooded other markets with high-tech goods like lithium batteries and also solar panels. So, in the world of trade wars, the exchange rate is the most powerful tool. China's $1 trillion success proved that as long as the country can manage its currency, it can protect its export from almost any tariff wall.
Assalamualaikum warahmatullahi wabarakatuh. My name is SOFIA binti Muhammad ZUKI, metric number 2317060. So now I will continue to explain about how tariff causes exchange rate volatility. I will be focusing more on how stronger or weaker US dollar will affect international trade balance and capital movement. So when President Trump introduced extensive increase for tariff in 2025, the cost of trading between the countries increased and the global trade flow were disrupted. Many exporters face high barriers when selling goods to the United States, which reduce the trade volumes and also disrupt the supply chains. Hence, the sudden and broad tariff created uncertainty about the future trade policies making investor more cautions and also causing the US dollar to fluctuate against the major currency. Moreover, a stronger US dollar made American export more expensive and less competitive in global market while imports become cheaper. This situation could worsen the US trade balance and increase pressure on trading partners whose exports were affected by both higher tariff and also weaker demand. So, the Reuters article also highlight that Trump tariff policy unsettled global financial market and also lead to investors to move their money frequently in response to policy announcement and the legal uncertainty. This movement of capital in and out of US asset affected the value of US dollar and caused exchange rate to become more volatile. Overall, the article shows that Trump tariff disrupted not only global trade relationship but also currency values and capital flow while increasing instability in the international trading system.
My name is ASMA and my metric number is 231180, and we will move to the next issue, which is interest rate and monetary policy spillover. Now I will explain about interest rate. The Reuters article highlights that uncertainty may persist into 2026 because trade tensions and policy direction remain unclear. This uncertainty makes it difficult for central banks to predict future inflation and growth. As a result, interest rate decisions become more complex and the risk of continued monetary policy spillovers remain high, with the US policy actions continuing to influence financial conditions across the global economy. When US interest rate rise, the return on US financial assets become more attractive compared to those in other countries. This creates an interest rate differential that encourages international investors to move their capital into US markets. As the capital flows into the United States, demand for the US dollar increases, leading to an appreciation of the dollar and depreciation to the other currencies. These capital movements are a major channel through which US interest rate changes affect the global economy.
My name is FAIQAH FAIZIN, matrix number 2312206, and I will further explain about interest rates and monetary policy spillover. So, when a major economy such as the United States changes its interest rates, the impact is not limited to its own economy. Instead, these changes spill over to other countries and affect global financial conditions. So, this happens mainly through several channels. First, investors move their money toward higher yielding currencies. For example, if US interest rate increase, global investors may shift their funds into US assets to earn higher returns. This causes capital outflows from other countries. Second, exchange rate fluctuate. Capital inflows into the US strengthen the US dollar, while currencies in emerging or developing economy may depreciate. So this affects trade competitiveness and inflation in those countries. Third, cross-border lending and capital flows adjust. Higher interest rate in advanced economy can make borrowing more expensive for firms and government in other countries, especially those that rely on foreign financings. So, in addition, trade uncertainty itself influences monetary policy decisions. When trade policies become unpredictable, financial markets become more volatile. As a result, central banks may choose to delay interest rate hikes or cut rates to support economic stability. Policymakers may also explicitly consider trade uncertainty when deciding on interest rates. So, monetary spillover are not just about domestic interest rate changes, but also how global trade policy shocks reshapes expectation, exchange rate, and capital flows worldwide. To conclude, Trump's 2025 trade policies disrupted global trade flows and encouraged companies to diversify their supply chains in order to reduce risk. And these trade tensions led to greater exchange rate volatility, which affected trade balances and international capital movement across countries. At the same time, slower global trade reduced economic growth and increased financial risk, particularly for developing and emerging economies that depend heavily on export and foreign investment. In response, central banks adjusted interest rate and monetary policies to support weakened domestic economies and maintain financial stability. Overall, this development highlights the fragility of global financial markets and show that trade policies and monetary policies are closely interconnected. They also emphasize the importance of international economic cooperation to reduce spillover risk in the global economy. And that's all from us. Thank you.